You're right, that FDA approval, the Pfizer and BioNTech vaccine, a big boost for equities globally, a stark reversal to what we saw last week when there was a slump, a lot of concerns about that Delta variant. But the idea now that this could be globally significant because there's been a lot of vaccine hesitancy within the US, and that could have really dragged on the global outlook. But this is giving more credibility to it, the idea that this could boost the immunization drive and actually make it legally enforceable for companies to mandate the vaccine. And we've already had several companies from Chevron, Facebook, Alphabet requiring workers to get that vaccine. And the idea that this could now encourage more companies to do so, something that President Biden also alluded to. It's also a very positive for that reflationary bet as well. We saw that Russell 2000 outperforming yesterday. It has been underperforming the S&P 500 over the past couple of months.
Yeah, and Ritika, then we heard from Morgan Stanley buy travel and cruise ship before October.
Yeah, Francine, a bullish call here from Morgan Stanley's Andrew Sliman. He is saying buy into that reflationary trade before it is too late. So he is snapping up those cruise lines, those restaurants, those casinos, some of those energy and reflationary plays. And he really cites three reasons for this. One of them is that basic idea of rates. He sees a floor coming to rates and that they're going to be moving higher over the next few months. He wants to get ahead of that. And of course, higher rates tend to be good for that reflationary trade. Another reason as well is that there's a lot of cash sitting on the sidelines and investors not sure what to do with that money. So he doesn't see for that reason that there's going to be a pullback in the S&P 500 coming anytime soon. And of course, also just that buy the dip mentality questions why investors would go to expensive tech shares or growthier names with those high valuations when you could go for some opportunities in some of those cheaper cyclical and value plays, Francine.
Ritika, thanks so much. Ritika Gupta there with some of the roundup that we're seeing from analyst notes. Now, joining us is Jeff Yu, Senior Strategist for EMEA Markets at BNY Mellon. Jeff, good morning, first of all. I mean, some of your calls are actually outlier calls, but is this a buying the dip or is this actually the restart of the reflation trade?
I would call it this week at the very least a reversal of what we saw last week. It was a very heavy risk-off tone, worries about growth, worries about the cycle, and of course Jackson Hole. So as we head into Jackson Hole this week, we are reverting to the mean, and at the same time, I think people are just acknowledging maybe this is not going to be an overly hawkish Fed, but I would caution that cyclically the world is still not in a great place. So these really risk-on calls, we need to be clear. Is it because of easy policy or is it because global growth is strong? I'm inclined to think it's simply a policy bet.
So, Jeff, what do you worry about? If the world is not in great shape, but actually markets are telling us that it is because of vaccination rates and the Pfizer FDA approval, what do you worry about?
So I worry more about the global growth cycle. I mean, over the last 2 months or so, we've been worried about China's regulatory crackdown. We're seeing the tech shares rebound, but consumer sentiment is weak. Yes, the Delta variant's probably under control in China, but has it happened in time to save the October holiday season? As we head into September, is there going to be a late year reflation stimulus coming from the fiscal side? I don't think so. Hence, if we have Europe sort of plodding along, US wondering what to do up ahead and worried about Delta picking up, and China at the same time not reflating as well, the simple question is, where is growth going to come from? And are we going to head towards stagflation? So I think this is the matter that risk-on markets need to resolve by the end of the year.
Where do you fall in the China debate? I mean, this morning and over the last couple of days, we've heard people saying it's uninvestable, others saying that's flat wrong. Obviously, we're not talking about for all eternity, but in the short to medium term, if they just change the rules on capitalism the way they have, it seems a little bit dangerous for Westerners, Jeff.
I'm on the that's flat wrong camp. So if you look at the medium to longer term, even the shorter term, we have a new round of index inclusion coming through on the bond side as well. The equity index inclusion, those flows on a passive basis, we are seeing it in our own custody data. And the fact is, yes, you can be squeezed back into the US, but markets are underweight Asia, markets are underweight EM, and actually that's where a bit of the value is right now. We like Asian currencies, Asian economies, which are trying to reopen. Singapore, Thailand, for example, even Australia, they're starting to change their tone on things. And China will need to reopen as well. But it is a growing market. It will be the world's largest economy over the medium term as well. So flows will head into that direction. From Beijing's point of view, they are learning to communicate better. We will see that too.
Well, what about, where then? I mean, in the U.S., buy the dip has been the right strategy, and the mega cap tech stocks have been the big winners. Are mega cap tech stocks in China a safe bet, or are those the very companies that Beijing wants to, I don't want to use the word crush, but, subdue?
I think mega cap tech, they are facing regulatory issues globally in terms of in terms of having a monopoly over the market position, over data. That is something that's being addressed in the US, in Europe, and China as well. A lot of people have highlighted that China's recent data protection laws, their model of GDPR, right? So Europe actually got there first. So these things will take time to iron out. Now, what I'm looking for in terms of equities right now, one phrase, pricing power. And the reason I think why the US is outperforming right now is the PPI-CPI spread is only around 2 percentage points. So that means companies can pass on their costs. In China and Europe, we're talking about 9 percentage points, right, or even wider. So this actually really hurts companies. They're facing high input costs. They can't pass it on via CPI, so their margins are going to be heavily restricted in the shorter term. So as long as US can actually maintain that cushion, then US stocks can outperform. But again, I ask, where's the cycle going?
Of course, Jeff, the performance of U.S. stocks is largely dependent on the performance of U.S. technology stocks, which, as we know, are pretty vulnerable to higher yields. The question is if we ever do get those higher yields. Do you think so?
So the Fed will take it very, very, very slowly. And then the second point is higher yields at what part of the curve? And I think we need to acknowledge if the Fed is going to start to tighten, you're going to see the long end of the curve. You're going to see yields actually come off because by definition, that's going to restrain the economy. And if these tech companies, if they're looking over the medium to longer term, if their financing cost of capital is more tacked on to the long end of the curve, then they should be okay as well. And I think that's one of the strengths that US mega cap tech will have over the rest of the world in terms of their cost of capital.
Jeff, thank you so much. Jeff Yu, their senior strategist for EMEA Markets.